Up till now, we've talked about the cost or market method as well as the equity method for accounting for intercompany investments. Those methods are applicable for investments where you own less than 50% of another business. How you account for a business that you effectively have control over, that you are a majority owner of, and these are investments, usually the threshold is 50 to 100% of the equity, owning 50 to 100% of the equity of the investment. The accounting for that ownership falls under the consolidation method. And this approach is actually far more challenging conceptually than the approaches we've been talking about up till now. Up till now, it's been generally fairly straightforward. You acquire an investment in another business, cash goes down, and an investment asset is created. And then as that investment is either generating income, growing in value, issuing you dividends, you sort of adjust your balance sheet to reflect that. The consolidation method is a completely different approach. And consolidation method basically says that rather than creating an individual investment asset, like under the cost, market, or equity method, which we've talked about, each target company asset and liability is consolidated into the balance sheet of the acquirer to represent that it's actually part of now the consolidated business. You're lumping two balance sheets together as if you own the whole thing, and that's that you own the entire investment, to really represent the fact that you have a majority control. The issue is that when you own less than 100%, so imagine you own 60 or 70%, the consolidation method still applies. And so you're still lumping 100% of all the assets and liabilities together as if you own 100% of them, even though you don't. To account for that, a new equity line item titled non-controlling interest is created in the consolidated balance sheet, which really captures the value of equity in the consolidated business that's not owned by you as the owner of the common equity, but of the non-controlling minority interests in the business. The folks that own the remaining, if you say you own 70% of the business, the folks that own the remaining 30% of the business that is now being consolidated, those are now minority or non-controlling interests in a consolidated business. So let's go through a simple exercise. Try to do this yourself, and then we'll go through it together, where you purchase 80% of another business with cash, and you purchase it for $80 million. And of course, let's, for the moment, assume that you're paying exactly what the book value would suggest. So you're not paying in excess of the book value of the business. So you hit the pause button, give it a shot, and then we'll go through it together. What's happening here is that instead of having cash go down and a new asset being created, we're actually combining the acquired target assets and liabilities as if we own 100% of them. And then when we get to the equity line, we're going to reflect an adjustment to identify the portion that we don't really own as the common shareholders of the investor's business. But now that there are these new non-controlling interests in the consolidated business. So let's go through this. So it cost us $80 million to acquire the target, and we did it with cash, which means there's an $80 million adjustment, but we're consolidating. So we're going to add all of these three together. So column A, B, and column C are all being lumped together under the consolidation method. So now there's a consolidated business with 1,200 or 1.22 billion, or let's use millions here to be consistent with the acquire. There's this much cash, 1.22 billion in cash. Other assets, there are no adjustments there. We simply lump the acquire and target assets, and we have 1.1 billion in assets. So no adjustment there. So total assets are now simply the 2.2 billion plus 200, so 2.4 minus the 80, or 2.32 million. Okay. Or I should say 2.32 billion. I know I'm switching denominations here, but it'll make things a little easier. 2.32 billion. Liabilities, no change there. If both companies had some debt on their books, they can just lump the two together, and we're not going to assume any sort of any refinancing or any sort of changes to leverage. All the information we have is we just bought the company. So consolidation method said we lump everything together, no adjustments. We simply get 1.1 billion in consolidated liabilities. Now here, these last two line items is where it gets interesting. So by virtue of us buying 80% of the business, that means the 20% of the business is still owned by others. We call them non-controlling interests. And now there are non-controlling interests that own $20 million of something that has $100 worth of book value. This is the book value. We own 80 million of it. So now non-controlling interests still retain 20% of that. So that's the adjustment. And we have a 0.02 billion creation of this non-controlling interest line item. What's happening here is that we have the elimination of the target equity. So the only thing that remains is the acquire equity. So the acquire equity of 1.2 billion together with the non-controlling interests and the liabilities equals 2.32 billion, which exactly equals the assets. So this is the basic in day one initial investment accounting for when using the consolidation method. So let me go to the next slide where you actually see this in a slightly better print. And you see these transactions happening. And the key takeaway here is just understand that unlike the other approaches where you are not reflecting control of the business, here you're lumping all the assets and liabilities together, and you reflect the portion that you don't own as this sort of equity item. It really sits between liabilities and equity as a line item that represents equity owners in the business that aren't you being the common equity shareholders. These represent owners in that business that you have a majority stake in, and they have 20% ownership in that. If the business had a book value of 100 million, that means they have $20 million worth of value. Again, the assumption here is we're not paying above book value. Things get a little dicier if we pay above book value, which we're going to get into shortly.